Charity accounts for non-accountants.
Hello and welcome to Accounts for Non-Accountants. I'm Catherine Biscoe, one of the partners in the charity team here at Buzzacott, and I'm going to be talking about judgmental areas. As you have heard, there are lots of rules and specific provisions governing charity accounts. However, quite often they don't necessarily tell us how we're expected to apply them, because accounting and reporting in the UK is a more principles-based activity rather than the very sort of prescriptive one that you might see in the US or some European countries, for example. So during this session, I'll be exploring some of the areas where there are judgments and decisions that can be made about how you interpret requirements, and also where variations in the financial value that you attribute to different financial statement areas can make a big difference to what gets reported in your accounts, when it's actually really down to quite subtle judgments. So really just to assist those that aren't day-to-day accountants in being able to know which are the areas in a set of charity accounts that you might want to dig into a bit deeper. We will be talking about the level of detail provided in financial information, not giving people too much detail to worry about, which might detract from the bigger picture. Also looking at judgments that trustees are able to make and accounting choices that are based on their own decisions rather than external events. And reading between the lines, so what to look out for, what questions to ask if you're looking at someone else's accounts, so perhaps as a grant maker or as a trustee, and how often actually what isn't there is just as important as what is there in front of you in those accounts you're looking at. So let's start by looking at this page of financial information. So what stands out to you in these figures? And this here is a bit of an exaggerated example. It does include spelling errors, some unhelpful descriptions, but really different stakeholders looking at these might have different comments. Now, what I have is a slightly tidier version of the same numbers, and hopefully you can see the difference that this presentation makes. I think, to be honest, I'd be tempted to tidy them up a bit further, maybe put all of the expenses under one heading if they want to look into that in a bit more detail. But the key points are really that if you look at these big broad headings, so the service provision, for example, there might be 3 or 4 different types of expenditure within each of those headings, and each may have sort of gone up or down from prior year respectively. So actually maybe a bit more expansion on what's included under each of those headings would be beneficial. Likewise, if we're looking at salaries, it doesn't really tell you which salaries relate to which activities, that sort of thing. And then really those smaller figures. Sometimes people put these in accounts because one year a trustee or somebody may be asked to put a note, a bit more detail on that, and then you continue to do so. But it could just be a bit of a distraction from the big picture and lead to micromanagement. So probably the key judgment in preparing a set of financial statements is assessing solvency and whether you remain a going concern. And this has always been a key judgment, but in the current environment, sort of coming through the impact, the aftermath of the COVID pandemic, the situation in Ukraine, the cost of living crisis, a lot of organisations are actually now under a high amount of financial pressure, and really assessing whether or not they're going to make it through the next 12 months has become a bit more of a question mark. So going concern, it's a concept that accountants use a lot, and it can sometimes cause slightly more apprehension than it needs to. But basically, it's the principle that you need to prepare your accounts on the assumption that you're an ongoing business and that you will still be here in a year's time and that you can pay your debts as you go along. So it's not based on certainty around that, but it is about being probable that if your income continues to come in, you manage your expenses and so on, then you can carry on as an ongoing business. And there's always going to be an element of assumption and uncertainty. And I think a lot of people that come from the commercial sector into the charity sector perhaps get a bit nervous, particularly around the fact that fundraising is quite often something which has a big hope target around it. And really the income only crystallises as the year goes on. Unlike a lot of trading organisations, the income in the charity sector is a lot less predictable, for example. It was the case once upon a time that if you did see the words going concern mentioned anywhere in a set of accounts, you got a bit nervous. It wasn't really something that you would normally refer to unless there was actually, a big issue or maybe you were about to wind up as an organisation. But actually these days it's the default position. So you need to disclose in your accounts that the basis on which you have prepared these accounts is the going concern basis, and usually that there aren't any material uncertainties around that. But if there are, then just explain what they are and be able to give your stakeholders the reassurance on why you think you can manage them. It's also the case that auditors now also have to report on going concern in every set of accounts. So there's a bit more wording on that in our audit report. But typically that wording is just to say that we agree with your trustee's conclusion that the account should be prepared on the going concern basis and that we don't think there are material uncertainties that we need to flag. I think if there are material uncertainties, I just emphasise that, quite often it may be something like you haven't renewed your main contract this year, or you haven't renewed an overdraft. But as long as you can disclose that and sort of give a reasonable case for being able to say that you're confident that that is going to happen, then it isn't really as big an area of concern as some people might think. So as an example of this, let's look at the financial information here and answer the simple question: is this charity solvent? So just having a quick look at the figures, I think in any commercial organisation, if you saw this positive net current assets balance, obviously in the context of the value being proportionate to the trading income and expenditure levels of the organisation, then I think you'd be quite happy that this is probably a fairly solvent organisation. We'd normally ignore the 1 million fixed assets because you can't dispose of them and turn them into working capital, so you actually need those as assets to run your organisation. But the 150,000 over net current assets, that would be a reassuring factor. However, in a charity, it's a bit more subtle than that, and we'll see that on the next example. So the additional breakdown that we've provided here of the same figures, this is something that should be shown in all sets of charity accounts. It's actually called the net assets between funds note, and it's usually near the back of the accounts, but you can also, and you sometimes see it, the balance sheet presented in this fund format. So in a similar way that you see the format of the statement of financial activities you might be more familiar with. If you split the assets and the liabilities of the organisation across the different funds that those assets and liabilities belong to, as we've done here, then you quite often see a bit of a different picture. So again, fixed assets, these would normally be treated as a designated fund. So as we said earlier, set to one side because you can't really use them. You need them to run the organisation. You may also have decided that you want to invest in a new project, something like that. So you've set aside some funds, which actually means that some of your liquid assets might be tied up in designated funds already. And then if you look on the right-hand side, just before the total fund column, you can see the restricted funds. So really these are funds that you're sitting on and you're waiting to apply for those specific purposes, and they're not part of your sort of general funds available to spend on any sort of charitable expenditure. So then we basically need to look at the middle column, and that's the general funds. And this is what we'd normally regard as being the reserves of the charity. So really taking restricted funds, fixed assets out of the equation. And here you can see there's a negative 300,000, and we've put it in red just to make it more obvious. And this means that actually if you think about this charity's reserves, despite the fact that the first balance sheet that we looked at looked reasonably healthy, it's actually got quite a serious deficit problem on its general fund. And that's really the kind of thing that you would need to be digging a bit deeper into, asking a few more questions. I want to talk about accounting policies next, and there are some accounting policies areas where there is an awful lot of judgment and decision making that might be applied, and it's really important to understand the specifics behind that. So the ones that we're going to touch on very briefly are depreciation of fixed assets, cut-off and timing, so really looking at what period items belong in, and then the principles around entitlement and measurement uncertainty. And then at the end, we'll also look at some of the specific disclosures you are required to include in accounts. So we have some images here to help with focusing on what depreciation is and the key things that we might have to think about. And the first image is a picture of a building. And really that's one of the most controversial areas when it comes to depreciation, because we all think that buying property is a one-way street in terms of value. So why should we be reflecting a reduction in value in our accounts year on year? But the accounting principle is that we need to recognise the cost of acquiring the building over the length of time that we're able to use it for. And that's usually restricted to 50 years at the most. But it might be the case that the building is so old or very structurally brilliant, it might be a historic building, something like that, and actually the value is never really going to get used up, in which case there might be an accounting choice not to depreciate it. But clearly the decisions around setting the useful economic life and depreciation of an asset of such significant value will make a big difference to the expenditure that you recognise in your accounts every year. The middle picture is a Babbage analytical engine, I believe, which is a very old computer. And really here, this is just to illustrate the point around the useful economic life of IT equipment. And really, particularly if you go back a number of years, most organisations, and particularly in the charity sector, were possibly sort of stretching out that useful economic life of IT equipment. But then on the other hand, you also need to be mindful of the fact that you may have fully depreciated assets that you're still using. So again, you may have not got the useful economic life right there. So something to think about. And then the final point is about what we call component accounting. So the picture here is the MS Oldenburg on its way back and forth from Lundy Island. And the point here is that it's a boat, but do you look at it as just one asset, or is it actually a collection of quite different assets with quite different useful economic lives? So you've got the hull, you've got the main structure. That might last for sort of 30, 40, 50 years, that sort of thing. You've also got things inside it, so radios, catering equipment. That might actually last for very different periods of time. But really just to illustrate the point that accounting standards say that when you've got quite obviously sort of different components that are actually a collection of assets, and the individual items within that asset have sort of significant different lengths of useful economic life in their own right, they should be treated as such. So for example, if the radar needs replacing, you would have to write off the old radar and then capitalise a new one. So that means that you would have to identify the cost of the initial radar separately from the rest of the boat when you bought it. The next picture round is a bit old, but it does still help make the point, so we'll go through that. And so Jamie Hewitt took part in a TV challenge programme for one of our clients, and at the end of the programme he declared that he was pledging the money he'd won for his charity, which happened to be our client. So the point here is that because the pledge had been made and that was within the charity's financial year, even though the TV channel didn't then write the cheque until some time after the year end, because that was deemed to be a credible pledge, it was made very publicly on television, the charity recognised this as income in the year and showed a data for it at the year end. But the charity might have decided not to do that. They might have thought there was some uncertainty over receiving that pledge. So actually really just having a look at what some of these key figures and large figures in accounts are where there could have been a decision one way or another as to recognise or not is important. The picture of the mobile phones, that refers to the fact that they are goods for distribution, so there might be lots of organisations that collect second-hand IT and distribute it out in countries where there is more of a need. So these funds will only be recognised in a set of accounts to the extent that they actually have a value to anyone. And the point here is that there might be two ways of accounting for it. So some charity shops, for example, will try and recognise their donation in the shop as they receive these items, put a value on these in the accounts, whereas other charities will say that's far too difficult, not really a credible thing to do, and only recognise the donated items as and when they've actually been purchased or given out to other people. So really understanding the policies behind that is very important because it will show different results. And then the final point is around paperwork. So there are lots of clauses in the SORP that say that you shouldn't really use paperwork as an excuse for not doing the accounting properly. So just because your grant agreement says that you've got to submit a report at the end of the project doesn't mean that you're not entitled to the income as you deliver the project. But again, some charities adopt policies that actually say we don't recognise the income until we submit the final reports. And that would actually make a very big difference to a charity's income. In the first instance, the charity that recognises income as they spend the money would be showing pretty much a neutral balance on its funds as the project goes along, whereas in the second instance, the charity would show a big deficit, building up right up until the end of the project when suddenly it recognises all the income. So really those subtle differences in accounting policy can actually make a big difference to the figures in financial statements. Next, I want to talk about two particular areas in charity accounts where interpreting the SORP's recognition criteria for sort of income expenditure, assets and liabilities might be more judgmental or nuanced, and these are legacies and provisions for grant liabilities. So the SORP criteria you need to meet in order to recognise income in your accounts is entitlement, that's the first hurdle. Then there's the probability that you'll actually receive the money. And then there's being able to measure what's the actual amount that you're going to receive. So in the case of legacies, if there are known values to the items in the will, then it's usually probate that is taken as the point at which you would recognise the income. Some charities do take a slightly later or earlier point of recognition, depending on sort of how certain they are, how firmly they believe that the estate is going to be distributed to them. However, there's quite often things like, legal disputes from relatives, or valuations of assets that are uncertain, or assets that are held in jurisdictions where it's difficult to realise them, for example. So a legacy might be a very significant item in terms of value, but not actually recognised until right at the last minute when the cash arrives. So really understanding the background to that recognition of those big areas is really important. If we look next at multi-year funding and obligations to pay grants, I think intuitively most of us think that if you commit to fund a student for, say, a period of 3 years, you would normally recognise that funding over the years that they're doing the course. But unfortunately, accounting standards say that if you make an open-ended commitment and there's no sort of further barrier to you then having to pay that money out to the student for the 3 years, then you should recognise that commitment up front as soon as you've made it. However, there is the case that in most funding agreements you might include, I don't know, some kind of minimal review each year to make sure possibly that the students attending the course, that he's achieving or she's achieving the satisfactory grades. So as long as an agreement includes a review point at which you can in principle break that funding, then you can recognise the funding year by year as the person receiving the funds passes those checkpoints. However, that really does depend on you having the control. So you don't ever have to have exercised it in practice, but it does have to exist in the agreement in theory. Another really judgmental area in charity accounts is designated funds. And this is something that accounting standard setters don't intuitively like, because it's really accounting for something that's only happened inside the decision-making process of an organisation. So designated funds are where you've got some surplus funds to fund specific things in the future. That might be a project, it might be acquiring an asset, it might be investing in a sort of new strand of activity, something like that. And as trustees, you can decide to set that money aside for the future purpose, but equally the next day you could decide to release it back to general funds if something else came up. However, while it is set aside, as long as the intention is credible and it's real that you're going to be using that money for that particular purpose, then it doesn't count as part of your free reserves, the reserves calculation that we looked at earlier when we were talking about solvency. And it should be clear to readers of your accounts when they're looking at what funds you've got available for all of your charitable purposes going forward, that that money is already spoken for, as it were. But I think, again, the key thing here is that it's judgmental. And then finally, to come back to one of the points that I made right at the beginning, which is that it's just as important to think about what might have been said in a set of report or financial statements as what you've actually got there in the figures in front of you. So what's missing or what might not be said? And that's really important for us as auditors, but it should also be important for you as trustees or potential grant makers to know what you're looking for. So when you're looking at restricted funds, for example, you're supposed to have an analysis of what all of those funds are for, where they came from, what they're going to be used for. If that's not there, if there's not enough detail, it's a bit vague, there's maybe just the one heading called restricted funds, you really should be asking some more questions. Your reserves policy, we've talked about this already, that's really key. And it's really important that it's logical, it's plausible, it doesn't sort of change every year just to reflect actually what the funds that the charity has at the year end are. The note that we looked at earlier where we'd sort of spread the assets and liabilities over funds so you can see whether there's actually enough liquid funding sitting in the general pot, that's a really important note. And that can sometimes be left out, possibly if it doesn't show a very flattering picture. So maybe if you don't see that, then do ask about it and wonder what's going on. And finally, if you know that the charity has relationships with other organisations or a key donor or a founder, something like that, and there's no mention of that relationship anywhere in the accounts, then again, you should be asking some questions, because there are some very clear reporting rules that say that those kind of relationships and transactions should be disclosed. Not because there's sort of usually anything untoward about that, but just because that way you can see that there isn't, if it's clearly explained and transparent in the financial statements. So really that was just a few ideas of things that might not be set out in accounts that might make you wonder and hopefully ask a few more questions. Thank you for listening.